Decentralized finance promises to replace banks. No middleman taking fees. No waiting 3 days for transfers. You control your money completely. Sounds perfect. Until a smart contract bug drains $600 million in one afternoon. DeFi offers things traditional finance can't, but it also has risks banks eliminated decades ago. This video explains both sides honestly. DeFi stands for decentralized finance. It's financial services, lending, borrowing, trading, saving, built on blockchains instead of controlled by banks. You connect your wallet to a DeFi app. You can lend crypto and earn interest, borrow against your crypto without a credit check, trade tokens without a centralized exchange. All of it runs on smart contracts. Code executes automatically. No bank approves your loan. No broker processes your trade. The code does everything. DeFi is permissionless. No one can deny you access. No minimum balance. No credit check. No account freezes. If you have a wallet and crypto, you can participate. DeFi is transparent. Every transaction is public on the blockchain. You can see exactly how much money is in every lending pool, every liquidity pool, every protocol. Banks hide their balance sheets. DeFi can't. DeFi is composable. Apps plug into each other like Lego blocks. You can use one protocol's lending rate inside another protocol's trading strategy. Banks are walled gardens. DeFi is open infrastructure. DeFi has no insurance. Your bank account is FDIC insured up to $250,000. If the bank fails, the government covers your loss. DeFi has nothing. If the smart contract has a bug and gets exploited, your funds are gone. Permanently. DeFi has no customer support. Banks have call centers and dispute resolution. DeFi has code. If you send funds to the wrong address, no one can reverse it. If you get phished and approve a malicious transaction, there's no fraud department to call. You are your own bank. That means you're also your own security team. Smart contract risk is the biggest. Code can have bugs, even audited code. The Poly network hack stole $600 million from audited contracts. The Ronin bridge hack took $625 million. These weren't phishing scams. The code itself was exploited. Risk 2. Rug pulls and exit scams disguised as DeFi protocols. A team launches a lending platform, attracts deposits, then drains everything and disappears. Risk 3. Impermanent loss in liquidity pools. You can provide liquidity and lose money, even if both tokens go up in price. The math is complex, and most beginners don't understand it until they've already lost. DeFi makes sense if you're in a country with unstable currency or banking restrictions. If your government can freeze accounts or your bank charges 30% interest on loans, DeFi is a legitimate alternative. DeFi makes sense if you understand the risks and use protocols with years of track record, Uniswap, AAV, Compound. These have been battle-tested. Billions flow through them daily. They're not risk-free, but they're exponentially safer than brand-new protocols. DeFi makes sense for amounts you can afford to lose while learning. Treat it like a high-risk investment, not a savings account. If you need stability, insurance, and customer support, banks win. If you're holding money you cannot afford to lose, rent, emergency fund, tuition, keep it in a bank. If you don't understand how smart contracts work and don't want to learn, DeFi is not for you right now. There's no shame in that. Most people don't need DeFi. They need a checking account that works. DeFi is an option, not a requirement. DeFi isn't safer than banks. It's different. You trade counterparty risk for smart contract risk. You trade customer support for full control. You trade insurance for permissionless access. Neither system is perfect. Banks fail. Smart contracts get exploited. The question isn't which is safer. It's which risks you're better equipped to manage. And for most people starting out, that answer is still banks. Comment DeFi if you're already using it, or banks if you're sticking with traditional finance for now. Next video, I'm explaining liquidity pools, what they are, how they work, and why people lose money in them even when they think they're winning. Subscribe to Unbanked. The old money had a head start. You have the internet.